Hello and welcome to a brand new show on Summit Inside Options. I'm Jane VG. If you're watching this show, it's likely you're familiar with the ins and outs of trading shares. But as the name suggests, Inside Options aims to give you the know-how on trading options. Joining me today is my co-host James Boardman from the JSE's Equity Derivatives Division. And over the next 4 months, we'll be taking you through the A to Z of options so that by the time we're done here, you'll be raring to go, whether you're an individual trader or a broker. So James, great to have you here. And speaking of brokers, there's this sense that options are quite sort of difficult to learn, to trade with, that there's this kind of this mystique around them, and I think the aim of this series is to break that down a little bit and to make them
absolutely available. We originally had that as it was a preconception with futures as well when we started the single stock futures market in sort of 2003. It only really started taking off until 2004. We really got the single stock futures market going. It is a process. You do have to put in some time, some effort, and that's what the show's about, is helping brokers, the general public, anyone out there who's interested in investing and learning a little bit more about options. They're a fantastic tool for risk management and for taking risks. So they're really something people should know about, even if you decide not to choose them. To not know about them leaves you in the dark about all sorts of things that will happen in the market. Gives
you options at least, doesn't it?
Exactly.
James, before we move on to some of the history of the options, because I think that's what you're going to be taking us through today, can you tell us what the JSE's role in facilitating this particular financial instrument is?
Well, obviously, like all our products, we provide a market for it. It's a centrally regulated platform that people can trade on with strict rules of buyers and sellers, bringing them together. And a part of that is about education. You've got to educate people about the product and how it works and the procedures involved and how to book a trade, why to book a trade, why it might be a good idea, why it might be a bad idea. So you've got to really think about all these aspects together. And so we decided a big part of it is education. In the States, they've got 7 massive options exchanges in different big cities that have sort of grown up independently. And they've had amazing growth in their options markets over the past sort of 20 to 30 years. Across the industry, they've got a body called the Options Industry Council. And the Options Industry Council has this overarching body for everyone. And they said to us the main reason for their success over the past years has been 3 words: education, education, education. And all over the web, and they've got TV shows and seminars and sort of getting it into the financial media as well, that people have this great awareness of options in the States. That's lacking here. People here, a lot of them trade futures, they understand those quite well. Yeah. And in the States, that market, our futures market, is generally people trading options.
Okay, so that's what we're going to be doing on the series, educating investors. Is it possible with options to get sort of several 100% returns?
Yeah, absolutely. You can get several 100% returns, and over a very short time period. And you can actually do that with limited risk because it's this lopsided thing where you're paying a premium and you get your position and you've got one-way gearing. I mean, when you understand the concept of one-way gearing, it's something quite incredible to see. And so you've got limited risk, but you can still get several 100% returns. It's also fantastic for hedging, managing risk, all these sort of complicated financial transactions where you can manage your risks. A lot of the time, doing it with options is probably the better way to do it.
Okay, so James, I believe in tonight's show you're going to be taking us back in time a bit to better describe where options come from.
Yeah, absolutely. Options are about choice and risk. They're about the risks you choose to take and the risks you choose to avoid. They're about probabilities and profit. So what is an option? An option is the right, but not the obligation, to buy or sell something at or before a specific date in the future. Having the right to buy at a guaranteed price at some point in the future is called a call option. Having the right to sell at some point in the future is a put option. To obtain this right, a small amount is paid to the option writer or seller, and this amount is called a premium. So most people in South Africa are largely unaware, but there is an active market in South Africa in options on many different underlying products. At the JSE, we have options on shares, share indices, currencies, interest rates, and commodities like maize, wheat, oil, gold, platinum, and copper. Each day around the world, billions upon billions of dollars of options are traded. So we will take you inside this fascinating world of calls and puts and profits and losses. And hopefully, in doing so, we'll open up a whole new way of thinking about investing and trading and a world of new financial opportunities. So hopefully, by watching this show, you'll learn a lot about investing, finance, economics, little bit of economic history, and most of all, about financial options.
Right, so how old are options?
The first recorded account we actually have of options is from about 2,500 years ago. And we've actually got a picture up in studio here of the father of philosophy and
Thales.
options trading. It was Thales of Miletus. Now, Miletus is an island off Greece, and he was a philosopher sort of in the Greek sense, where he was more sort of scientist and mathematician, as much as a sort of speculator with sort of Hobbes and Descartes, as we would see it now, being a philosopher. So what he did was he lived quite a simple life in Miletus, and he was reproached by some of the citizens. And these citizens said, why are you so poor if you are universally acknowledged as being the cleverest philosopher living today? And he sort of replied it was a choice. They said, no, you wouldn't choose to be poor. That's ridiculous. So it shows that philosophy is not much good for making money, and your science is sort of pointless. So he decided he would make some money. He was very, very skilled with astronomy, and he predicted that the olive season that year would be a very good one. The past few had been quite poor, and so what he did, he knew there'd be a huge demand for olive presses to turn the olives into olive oil. So olive oil in ancient Greece was used for food, for lighting. It was a vital bedrock key crop of their economy, much like oil is to today's economy, or more regionally, like mealies are to the Free State. So what he did was he went out and bought the right to use the olive presses. Now, I think I've got an image. There's another picture of Thales. Here we go. That's an olive press. So you can see that massive sort of stone thing. It's not something you can make in a weekend. It's a big production. So he went out before the harvest, and he bid on these rights. And because no one else was interested in paying in advance, he bought the right quite cheaply. The harvest came, and he was the only guy who could turn these olives into this oil. And this was the vital commodity of ancient Greece. So what he did was he created an artificial temporary monopoly by cornering the market. So we call it a market corner. And in economic terms, it's a creation of a temporary monopoly. And he did that, and he became quite rich. And he proved his knowledge and wisdom and his skill in astronomy and reading the seasons were very, very useful, in fact, for making money. So another historical story, jumping several thousand years later, was where options were used for a totally different purpose, is in the Dutch Tulip Mania. So in the Netherlands in the 1630s, there was this passion for tulips. People started paying crazy prices for them, and they were traded on a sort of futures exchange. It wasn't a futures exchange like we know it today. It was just a central meeting place where people made bilateral deals. So it was just two random blokes in a pub making this gargantuan bets.
It was
on
that
tulips.
great, it was that fantastic flower market, wasn't it?
Yes,
Because that
and
was the center
still
of
there's this
everything.
legacy of tulips in Holland, and that was where it really all got started. They actually came from Turkey, and the great Ottoman sent them to the King of Holland to say thank you and some part of some diplomatic relations. So things got completely out of control. They got very, very high, the prices for tulip bulbs. So I've actually brought a tulip bulb today, and this is a tulip bulb.
That's the original option.
There you go. They had tulip bulbs. People were paying 10 years of a skilled craftsman's labor for this tulip bulb. So you can see this is a completely mad bubble where people, this may or may not, this tiny sort of thing looks like an avopip. It may or may not turn into a tulip that is a beautiful flower, and people are paying 10 years labor. I mean, if you think about that today, that's like 1 million, 2 million rand.
And I think
they're paying for this, for one of these.
Yeah.
You know, I mean, whole estates were
hoping that they'll
swapped
turn into
in the
beautiful
hopes-
black tulips.
turn into a beautiful tulip, in the hopes that they could really sell it on to someone else for more money. So it was a speculative fervor.
So, James, then what is the impact of this tulip craze on the market?
This mania sort of caused huge alarm across the whole Dutch economy. People were betting vast fortunes. There were some very scathing pictures and stuff done, and a lot of people stood to lose fortunes when they had to take delivery of these tulips if the price had crashed. So the Dutch Florists Association actually got together, and they put this agreement to the parliament that they would turn all the futures contracts into call options. So with futures contracts, the buyer was obligated to buy the bulb at a price agreed upon, and he had to take delivery. With the proposed forced change to an options contract, the buyer could merely pay a penalty of 3.5% of the agreed upon purchase price, and the contract would be dissolved. So this was quite a clever solution to the risks to the economy posed by the tulip trade. So the reasons for this was there were far fewer sellers who stood to lose far less than the vast swathe of unsophisticated buyers.
Now that rings a bell, James. Aren't bank regulators looking at doing something similar today?
Yeah, they are. They're actually looking at something very, very similar. And in the aftermath of the global financial crisis, they realized that the capital requirements of banks should be slightly higher than they are today. And that's a big part of what the Basel III Accords and all these things are about. So they've been discussing ways to create bonds that banks could issue to investors called COCOs. And that's an abbreviation for contingent convertibles. So dependent upon something, contingent, they would convert into something else. So in the event of a crisis, these bonds would turn into equity and thus increase the bank's store of available capital. So this is because bonds' interest payments have to be paid, and with equities, only residual profits are paid out to shareholders at the discretion of the board. And with banks, actually the regulators have a big say in whether or not you can pay a dividend. So,
right, so the board
and the regulators, you may not get a dividend with a bank share.
But it just goes to show, I mean, these two historical stories tell us quite a bit about how things are working today, don't
Exactly. They really show you that in Thales' case, he used options to speculate, and he did quite well on it. In the Tulip Mania case, options were used as a way to reduce risk and transfer it around the financial system. So both of these uses will be looked at in a lot of depth over the course of the show.
All right, so a good way to trade the top or the bottom of an irrational bubble
Absolutely.
is to do so by using options, right?
Yeah, no, it's the ideal tool at the time of sort of a market irrationality. When you're in a bubble, if you go short, the market could keep rallying up and you could get carried out. If you stay long, the market could collapse and you could be in deep trouble. So it's very, very useful to either speculate just with options, as you know what your capped maximum loss is. With some of these .com companies, they went from sort of $100 to $1.50 in a couple of days.
Right.
So that's very, very difficult to hit any stop losses or manage your risk in that situation. Whereas if you just had a call option, all you'd lose is the premium. Or if you bought put options, you could protect your long positions.
So we see the importance of timing
Yes.
here.
So it's all about timing. That's very, very important to remember the timing. We saw with Thales, if he hadn't got the timing right, if he got the time of the harvest for when he booked the olive presses wrong, he would have paid all his premium and he would have lost a lot of money. We also saw with the Dutch Tulip Mania, people were saying it was nuts from year 1 or 2. It actually went on for about 4 or 5 years. So you've got to remember when trading, John Maynard Keynes' famous saying that markets can remain irrational for far longer than you or I can remain solvent. So in that sort of situation, think about using options.
Okay, James, we're going to leave it there for now. We're going to take a break, and after the break, we'll be coming right back, I think, to take a look at analogies of options, which might help us better understand as well.
Yeah, a nice, simple story.
Great.
Good.
See you after the break.